Hi, I'm Peter Herbert. Welcome to today's short CPD session. What we're looking at on today's session is the ever interesting topical issue of audit ethics. Here's our running order. We're going to start off with a very broad and quick reminder of the way the FRC ethical standard works now, and then drill down four specific common problem areas: long association threats, corporate finance work, accounts preparation work. So can you do corporate finance work and accounts preparation work where you are the auditor? And finish off with a quick look at gifts and hospitality. Let's begin with that very broad overview of the FRC ethical standard. And here it is, effective 15th of March 2020. Probably not as impactful when it came in as the 2016 revision, but certainly some impact. We're going to talk in today's session in a bit more detail about safeguards for long association and the prohibition on contingent fees, but a number of areas whereby the rules, which previously were a little bit grey in a number of respects and gave some scope for judgments, were kind of very much made much more clear and unequivocal. And that certainly has meant that certain things that you probably could do before under the previous version of the ethical standard, it's no longer possible. One I would just flag, refer to here on the slide, is the blanket prohibition on the provision of internal audit services. This has affected a number of our clients in the academy trust sector. I think prior to this change coming in, effective 15th of March 20, many audit firms in this sector also did internal control checking work for their academy clients. The Education and Skills Funding Agency, the ESFA, have unequivocally decreed that internal control checking is akin to internal audit work. And given that prohibition, it'll no longer be possible for audit firms to do both. So if you're doing both, you'll have to give up the internal control checking work and carry on doing the audit, or vice versa. Big change there, I think, for academies this last couple of years. Okay, let's look at a bit more detail at some specific situations, beginning with the long association threat. I think of all the questions we've been getting on audit ethics in the last 12 months, this probably is the most common. You are an RI, a responsible individual in a two-partner firm. There are several audits where you've been incumbent for more than 10 years. What should you do? I think the key thing to bear in mind with this one is that prior to the 2019 revisions, effective March 15, 2020, what you'd have to do in this situation would be to think about the need for a safeguard to mitigate the familiarity threat based on long association. That is no longer going to be negotiable at all. You've got to put the safeguard in. And yes, I guess in larger firms, that might not be massively impactful or burdensome, but I think in smaller firms like this, it very much will be the case. So safeguards, non-negotiable and must be applied. I guess the classic way to mitigate the familiarity threat based on long association would be independent review. And that, I suppose, begs the question, do we do the review hot before the audit report's been signed off, or do we do it cold after the audit report's been signed off? I think our view on this is that when you think about the way that the cold file review works, after the audit report's been signed off, by then it's too late. So I think we're very much looking at hot review here rather than looking at cold. And again, as I mentioned a second ago, for a larger firm, that might not be massively burdensome. There might be a lot of people around that could conduct that hot review. Much more difficult for a smaller firm, where it might be you've got a very limited number of RIs, a very limited number of managers that can carry out that review. It might be that you're therefore having to involve an external reviewer, which obviously is going to be an investment of time and obviously be an investment of cost. But hot, I think, is the key here rather than cold. So who and how often? Well, I mentioned a second ago, you could possibly look at getting a manager from your team involved, obviously a manager not involved in the audit. I think when it comes to manager review, in this particular context, I've always felt that manager needs to be appropriately experienced, appropriately qualified, and I guess as well have enough gravitas whereby if there were some sort of dispute or disagreement between them and the RI, who was the actual RI on the audit concerned, they'd have the ability, I suppose, to push back and challenge and make sure they got an outcome that was appropriate in the circumstances. I guess a lot of more junior managers, without that experience and that gravitas really based on lack of experience, they're often not the appropriate person to carry out these reviews. So for many firms, it will be the RIs, the partners, that will be the key people here rather than relying on managers. I guess the sense I've got in terms of the frequency of review, I think a lot of the files that we see whereby this issues arisen, maybe the sort of audits you come across in very much smaller firms may not be massively risky or massively contentious. And I guess for that reason, one might say, well, if you were to conduct a HOT review periodically, every couple of years, every 3 years, and then that might well get you over the line. Clearly, if the audit is more risky, or if things are changing in the organization, if there are particular risks that are prevailing 1 year that weren't there in the previous year, that will need to be given consideration on a year-by-year basis. But for a very simple, straightforward, open and shut audit, it may well be that a periodic review will be appropriate rather than a review being carried out every single year. I think what we'd also advocate in the situation would be an engagement quality control review, looking at probably the key judgments on the file rather than necessarily a complete drains up on the entire file. So I think hot rather than cold, but it may not have to be massively burdensome. Obviously, if the audit is risky and contentious, I think you'd require input every year. But for a more simple, more straightforward audit, I would suggest periodic review would be the way to go. Clearly very important on the file document, the basis for the conclusion you reach in relation to what that particular review would need to look like. I put a point on here as well to say that client approval is not enough. So in other words, it's not enough to say, well, because the client's happy for us to carry on beyond 10 years, that removes the need for the safeguard. It absolutely does not. I think also linked to that, what's very important to be clear on here in terms of the way the ethical standard frames this, is that you've got to think very hard as the incumbent auditor, in place for more than 10 years. What is the basis for me feeling I can carry on? Documenting that reason very, very carefully and communicating that very clearly to the client. I think in a way, the ethical standard here almost defaults to thinking that beyond 10 years, that familiarity threat is so great that you need to actually, as an individual, rotate off and get someone else involved. It's not the case, but document the rationale for feeling why it is appropriate for you to carry on, communicate that clearly to the client. And of course, it may well be that with the vast experience of that client and knowledge of their business, you're in a brilliant place to do the audit, perhaps more so than other RIs that might be working within your practice. Okay, so that's a quick look at long association. Let's move on to our next issue to do with corporate finance work. I think in the current climate, we are getting lots of situations where firms that we work with are telling us that their clients are selling their businesses. And let's look at this one here where we've got a particular firm where they've got 3 audit clients that are all looking to sell. They're asking the firm to help with that process and are actually telling the firm they'll only get paid for the work they do if the sales actually complete. Obviously, a very common feature of corporate finance work. It's very much a fee dependent on the outcome rather than a fee based on the actual amount of hours spent on the job, more akin, I suppose, to what you might get paid for a tax, a compliance piece of work or an accounts preparation work or an audit or whatever it might be. Yeah, I've had some quite interesting discussions with 1 or 2 firms about this recently. I guess the issue here is that we are potentially, as auditors, conflicted, aren't we, in the sense that if we are looking to actually get involved in helping a client sell a business, what might be perceived at least as being more inclined to dress the accounts up to look really good, to therefore make it more likely the sale actually will go through and we will therefore get paid our fee. Does that sort of inevitable conflict between what we want to do from a corporate finance point of view and from an audit point of view mean that we can't really do both pieces of work? Now, as we mentioned in the introduction a few minutes ago, really important, I think, to bear in mind that in the revised ethical standard, contingent fees are prohibited. I guess the question here is this in any way, shape or form a contingent fee? I think we think about, don't we, contingent fees perhaps being a fee linked to possibly what the actual company would be sold for. We might get 3% or 5% of the actual sales proceeds for selling the company. We're not necessarily getting told this here. We're probably getting paid on a time and cost basis, but the deal is we only get that remuneration in the event that the actual sale goes through. If it doesn't go through, then we don't get paid. So is this particular basis for remuneration therefore a contingent fee, and therefore are we not allowed to do the work, or is it non-contingent, in which case we are? I think where we've ended up in terms of our discussions with an insight discussing on sort of kicking this one around is that although one might say in this situation the fee is not contingent on the actual sales price, insofar as we won't get paid a percentage of the fee, there is still a contingent element in terms of the deal doesn't go through, then we don't get paid. That is what you might consider to be an output-based fee. The fee will only actually, pass to us in the event of that output, that deliverable actually being achieved. Where if you think about something like a corporate, like an audit or an accounts preparation job or a tax compliance piece of work, in that situation, the fee is much more linked, isn't it, to the input, what we put in, and we'll get paid, whatever. One might say in the context of an audit that if you are going to do an audit, you're only ever going to get paid if you complete the audit. But notwithstanding that, I think we'd still say it's still more of an input-based rather than output-based arrangement, insofar as if you start to do the audit and you fall out of love with the client and they decide that you don't want you to act anymore and they don't want you to complete the work, you will still get paid based on the work done to that point. So that does make corporate finance work on this basis, I think, somewhat tricky. I can't point to a rule which unequivocally makes that particular point, but that I think is generally where firms tend to end up. And clearly, if you're going to get remunerated for corporate finance work, literally on a time and cost basis, whether or not the sale goes through or not, that probably will make it very unappealing to the vendor in this situation. And it might therefore be in this scenario, you either carry on doing the audit and let someone else do the corporate finance work, or you do the corporate finance work on this output-based fee arrangement and someone else will do the audit instead. So interesting times, but challenging, I think, certainly for audit firms to do work in that area when the remuneration is on that particular basis. Okay, next topic is accounts preparation work. Here's our scenario here. So we're about to take on a new audit client. They want help with management accounts and bookkeeping. Is this allowed? There's no particular change here, I don't think, in relation to how it affects most firms day to day. Of course, it's being aware that you have got in a situation where you're doing management accounts and bookkeeping, potentially a management threat. You've potentially got a self-review threat, and you will, of course, need in an audit situation to ensure that you've got appropriately informed management to mitigate that management threat. You will need something to mitigate the self-review threat in terms of separate teams or independent review, but you can actually, quite easily in a situation of an ordinary private company audit, you can do all those things on the proviso that you do indeed have, the appropriate safeguards in place to mitigate the threat. The one I'm always very mindful that you really can't, in any way, shape, or form, kind of mitigate, though, is management threat. If you haven't got informed management to take responsibility for the key judgments, then really you're between a rock and a hard place, and that will be something really that you couldn't actually undertake at all. But that's just a question which you've had lots over the years. I think it's a reasonably straightforward one, but we still get it lots. And I thought I'd just throw that one in again into today's session to make clear where we would certainly be as far as that's concerned. Don't forget as well that for a small entity audit, you can use the provisions of PACE, so the provisions available for the audit of small entities, where you can, to a degree, carry on despite there being safeguards in place. I think in the context of management, I'm always very keen to encourage firms not to do audits where management are informed, even though you probably could under PACE. I think if you carry on doing audits where managers aren't informed, are you in the situation whereby you actually run the risk of becoming a shadow director? And that's really not one that you want to actually be or place you want to be. But the self-review threat, absolutely all day long, as long as that particular client management team is appropriately informed. And as long as that file is picked occasionally for cold file review, you can absolutely carry on doing the audit in that situation without the mitigant in the moment where the entity is small. That's the way that PACE works. Not every firm embraces PACE, but it's quite a helpful workaround really, where the safeguards are quite difficult to implement as far as the firm is concerned. Okay, last scenario, looking at gifts and hospitality. And here we go. You've been hearing on course for a long time that gifts and hospitality are off bounds. Do you need to take action? Well, I think the point just to remind ourselves of here, and again, we did lots on this a couple of years ago when the ethical standard, in its current format first came in. The big change was that where we previously had up until 2016, a situation where you were allowed to actually take advantage of hospitality where it was reasonable, the actual bar dropped massively to becoming you can only take advantage of hospitality where the actual value of the benefit you're getting is trivial and inconsequential. So very tough to actually allow yourself to take advantage of gifts or hospitality off the back of the 2016 changes to the ethical terms. So this has been around for quite a while now. And yes, gifts are okay as long as the value is trivial, as is hospitality. But anything more than that, you can't act, and therefore, or you can't take advantage of them rather. And that therefore does mean that this whole area of gifts and hospitality does indeed become a bit more off-bound than it would be before the 2016 ethical standard was brought into play. So thinking about actions, I think actions possibly would be needed. I mean, it's been around for a fair while. We do still find that firms do struggle with this. So I think what you need to have here probably is a policy, and I think what you also need to do is have a mechanism whereby where advantage is taken of hospitality, where advantage is taken of gifts, the information concern and the value concern is communicated to the ethics part, so they can keep a log of that, just to ensure they're happy that on a cumulative as well as an individual basis, the value is trivial. So that I think probably would be the key place to go if that protocol is not already in place. And that process I think will be challenging, particularly when it comes to getting non-audit partners on board, non-audit members of the non-audit teams on board. I think the key thing to bear in mind from a non-audit partner point of view is because they are so often in all audits from a smaller firm point of view deemed to be covered persons, they can't avail themselves of hospitality or gifts that exceed that triviality threshold any more than audit partners can. And it's getting that buy-in, I think, for people that is really tough when they don't work in the world of audit and will never for a million years therefore think that the audit ethics really is something that they would need to concern themselves with at all. But that policy is quite an interesting one, isn't it? So, and I suppose that the final point on this one will be, what if we are going to put a policy in place, where do we put the line? What do we make the limit? Now, again, I think some of the larger firms have better put the limit at nil. They're saying, look, let's just not even go there. Let's avoid this completely. And that will then, make sure there's no question mark about, what is and isn't appropriate in the circumstances. Lots of firms I speak to have kind of gone for a limit around the £50 level. But that, again, I suppose does pose questions about, would that be a cumulative limit for hospitality over a period, or would that be the limit for an individual, hospitality event, for example, and what would that period be? Either way, I think very important to make sure that you do put that procedure in place. As I say, it's not only having the rules there, but making sure there's an appropriate communication into the audit team. And yes, quite simple and quite straightforward, I think, for auditors to buy in, because they are being battered by this constantly on courses. It's the non-audit partners that I think are tougher here, tough enough to crack, but because they are deemed to be covered persons, they are very much in scope. So that is why, again, that one is always one we find is a useful one that's supposed to beat the drum on the sessions that we run. Okay, so there we are, a few sort of ethical issues. We started off with a very broad overview of the 2019 standard and then went through a number of specific situations, just literally based on questions we've been asked most recently around long association threat, corporate finance and account preparation work, and what you can and can't do, and gifts and hospitality. I think certainly from an audit cold file review point of view, we're very mindful that the ACCA and the ICW are very hot on this sort of stuff. So if they find you breaching the standard or a paragraph in the standard, they will take a very, very dim view. If we therefore find that firms are not compliant here, we do tend to raise that quite quickly as a key issue on the reviews that we do. So very important, therefore, I think, to be across the rules here and make sure that your firms are totally compliant. Okay, thanks for watching. If you want to get any more information about our full programme of autumn events, jump on to www.insight-training.co.uk. I'll be talking about a number of other ethical issues on the audit update in a few weeks' time. Any questions about today's session, do drop us an email, inquiries@insight-training.co.uk. Thank you for listening and look forward to seeing you very soon. Thank you and goodbye.